Hey everybody, it's Michael Lamott from ChartYourTrade.com, and today we have an excellent question that was given to us from Mikael in one of the comments on the last YouTube video. His question is this: thanks for letting me know the market has been this way, very choppy, for the last 8 years or so. Um, I read some other traders and they mentioned that these choppy markets were the most difficult for our style of trading, which is momentum and growth stocks. But they didn't happen so often. I'll have to think about how to adjust and count for this kind of choppiness. To help us understand the risk level, would you have a recent example from the last couple of years where the stock had a good entry point and the break of support was just 4 to 8% from that point? All the stocks that I typically find have support either so far away from the entry point, which means that either I will have to take such a small position in that stock, or if we want to put our stop below it and we only limit it to 7 to 8% of a loss, we can trigger a much bigger loss than we ultimately would have taken on the stock. And yes, we actually do have a very good example, one that is in our advanced stock reports current model portfolio. And the one that I want to show you today is Alibaba. So looking at Alibaba, we initially took our position right here, and so using the drawing tools uh, in this trading in this charting service called TradingView, we could just draw the little cup with handle that we saw here between September 2016 to when it ultimately broke out right ahead of earnings in January. And let's draw the handle right there. So that was the breakout right above 97.90. So we got in right around $98 a share when I broke out right ahead of earnings. And the handle right there was only about 3.5 or 4% deep. So what that means is that if Alibaba broke out and reversed, we would be out right around here, right? Right around 3.5 to 4% below the buy point. And yes, that was buying right ahead of earnings. And yes, that there is quite a bit of risk in doing that. However, based on the chart pattern, based on the momentum of the stock and the industry groups and how things were going, we were comfortable taking that risk. And like you mentioned in your email about position sizing, we can also adjust the position size to account for the added risk of taking a position ahead of earnings. So we could take a position that's half the size that we normally would, or we could use options, we could use call options to enter a stock like this. Well, what I ended up doing in this particular trade was for the model portfolio, I took it just as I normally would. And I had that in my intermediate term swing trading account. And since that point, we've basically just held on and enjoyed the ride to the tune of what is now a 70% gain since January. No, and looking at this here, we've only raised our stops on this trade a handful of times, and what we're doing is we're basically letting the 50-day moving average be our guide on this one. If you notice from the point of breakout, and even from when it initially crossed back above the 50-day moving average all the way back here. The closest that it's come to touching the 50-day moving average was back here on May 18th, and then very recently at the beginning of August, August 11th. And until, well, we get some kind of a definitive break of the 50-day in Alibaba, so we're staying long. You know, it's just a very simple but very patient, and it just sitting and being patient is often the challenge, but that's the game plan of what we're doing here. So this is a great example, and I hope that that helps you a little bit. Please feel free to leave your comments and questions in the comment section below. If you enjoyed this video, please click the like button and also subscribe to us, which is somewhere up there. So thanks again for watching, and we will see you again very soon.